All right. Hello and welcome back, everybody, to our ongoing series, The ABCs of Finance. I'm Anthony Gerbi, and this week we are on the letter L, which stands for loan. And before I get into that, if you haven't subscribed to our channel yet, that would really help us out. We'd appreciate it. So L for loan. Now, when it comes to loans, there's a lot of different angles I could go with this brief video, but I think, and this is very timely, one of the questions I get the most is, should I pay off this loan, mortgage, car loan, home equity line of credit, or should I just keep making the payments on it? And the answer to that question is, of course, different for everybody, but one of the big things it really comes down to is interest rate. And what I'll tell you, as of right now, when this video is being made, there is more of a reason than really in the past decade probably to consider paying off loans early, at least loans that are either new or whose interest rates float with the market. Now, if you've got your home mortgage and it's sitting at 3% or even less than that interest, probably doesn't make sense to pay it off. And that is probably true even if it's north of that slightly. But I am seeing now new mortgages, new car loans, floating loans whose interest rate changes over time, reaching the 7, 8, or 9% mark. And that probably is the point at which you would want to consider paying off the loan early. Of course, you need to think about where's the money coming from that you're paying off this loan with, because that's a huge key, right? But at those interest rates, where we're at now for new loans or, again, floating rate loans, it does sometimes go in your favor to pay it off. And the math is very simple. If you can make more on a dollar invested, let's say, than what your interest rate is, then you're coming out ahead. But if your interest rate is 7, 8, 9%, that would be a pretty good year for a dollar to return either in the market or in a diversified account or certainly in a bank account. So if it gets up that high, that makes me start to lean towards paying it off. Of course, the answer is going to be individual to you, whether you should or shouldn't. But at those rates and at the rates I'm seeing right now, it is something worth considering, while a year plus ago, most people shouldn't have even considered it. In terms of what's better financially, paying off a low interest loan or keeping the money invested. Well, keeping the money invested is better there. But for a high interest loan, that decision is a little bit more complicated. So if you're in that boat, we should talk about it and see what's right for you.